So, welcome everyone. This is our webinar on smart data, open banking, open finance, and the EU's financial data access regulation. We'll be drawing on our EU and international markets expertise, and we have a good hour to get a feel for how industry and tech ecosystems are shaping up and what all this means for the people who use them. We could, of course, spend many hours separately on each of these areas, and no doubt we'll be coming back to some of these. But the idea today is really to start getting underneath some of the more recent developments surrounding finance, how it all fits together, and how it all starts with data. But is it just about getting access to financial data, or is it really about a whole lot more? So I'm sure many of you know, open banking was originally engineered by the PSD1 and PSD2, or the Payment Services Directives, and is effectively a blueprint for institutional data sharing, particularly in operationalizing APIs or the application programming interfaces between banks, fintechs, and their agreed trust frameworks. The UK government here has also recently announced its acceleration of so-called smart data schemes as part of data initiatives outlined in the Data Protection and Information Bill, and focusing specifically on energy and transport. Meanwhile, across the EU, they're taking a similar tack, with efforts now being underway to develop 14 EU data spaces across sectors as wide-ranging as finance, health, mobility, agriculture, the Green Deal, manufacturing, tourism, and I could go on. But coming back to finance, as the objectives of the FIDAR are to build customer trust in data sharing and for financial institutions to safely share their data using high-quality data standards and interfaces, what was first about unleashing the power of bank-held data for digitalizing payments, well, this is now being translated across into many other areas of finance, as well as into other sectors. So what we're really starting to see is an explosion in the end user benefits and digital services across every data, everywhere, all at once. So today I'm joined by a terrific panel of experts. We're going to start first with Simon Lyons, who is the Chief Strategy Officer from Obconnect, who'll be touching on how open banking has been evolving. We'll then hear from Jakub Piotrowski, who is VP of Product at BID, along with Dr. Xitong, who is Professor at HEC Business School Paris, about what it means to really process data and how data ecosystems are really shaping up, including for digital assets. And we'll also hear from Marie Walker. Now, Marie is Raidiam's very own resident open futurist, and she will walk us through the key aspects of the FIDAR with a look across to Latin America. We'll have about 20 minutes to engage in panel discussion where we'll take your questions. But before we kick off, just a couple of housekeeping points. Just to remind you that we are recording the webinar, so if you don't want to be on camera, please keep your camera turned off. And secondly, I'll be attempting to use the spotlight for the speakers, so you will notice that your screens are dark, but I will bring everyone's camera back again for the Q&A. And don't forget to put all your comments, views, and questions into the chat so that we can pick through these for the panel. So let's get going, kicking off with Simon, and let's find out what's been happening in open banking.
Thank you very much. I've got 7 minutes. So what I thought I'd do is because I'm going first, I'll do what the UK's open banking did as well. They went first. And I'm probably going to give you a little bit of a different dialogue than most would, but humour me, because I want to talk about what this thing does and what the benefits are as well. Before open banking, first of all, there were lots and lots of banks that had to build lots of types of connectivity to lots of customers in lots of different ways, depending on the way the customer wanted it, and depending on the way the bank wanted to deliver it. We did what the bank told us to do. If we wanted to service our bank, we used their channels, we used their digital, we used their branch, we used their telephone. We used things like Sterling Connect Direct, we used VPNs, we used ISDN lines, if you're old enough to remember it, and we even used things called PC Anywhere. And then open banking came along, and something quite dramatic happened. What we suddenly had was a very, very level playing field, so that if I wanted to deal with one bank, I could deal with that bank the same way I could deal with another, and then another. the UK made some very, very smart decisions about mandating the 9 banks, we call them the CMA9, to go and behave in the same way. And that gave us a really, really important statement. The statement was standardization. And standards and rules are the underpinning of anything successful around the world. Very quick example. If you take your card, if you have a Visa, a MasterCard, or an American Express card, you wander around the world, you can use it almost anywhere. There are a couple of territories you can't. But the reason you can do that is because of standards and rules, because the standard that they use to talk to a card from merchant acquiring anywhere in the world is the same. And it's so important to come back to that point, because without those standards and rules, you can't have growth. And the proof in the pudding is very, very simple. When open banking was launched, I'm going to give you a very rudimental example in the UK. There is 6.1 million small businesses, for the sake of argument, in the UK, and they all used to take their bank statements and their receipts to their accountants, and some of them used to scan them, and some had little small Spanish practices to do it, and the accountant would create their bookkeeping. Well, suddenly with open banking, all these legacy methods that we had from banks transferring bank statements and banks transferring data and screen scraping and exporting data, they all disappeared. And if you look now at the 3 big accounting providers in the UK to SMEs, Sage, QuickBooks and Xero, they all use one service. And that service now would mean that the accountants would encourage their clients to use a bank that has a good open banking connection. There isn't a stronger argument to explain the benefit of open banking than the sharing of data for business and bookkeeping. It is the perfect use case. Interestingly, that case then leads on to better lending. If the accountant can actually gain the information of the client quicker, then they can get a clearer example of what the customer's cash position is. Because we don't lend on accountancy, we don't lend on our end of year figures, we lend on bookkeeping and cash flow. I'm a banker and not a technologist, and I've built many cash flows that will tell me what a business looks like. So if we take that example straight across now, we've got the standards and rules, and we've got open banking, and then we've got the retail user. So for many, many years, we've been told how to judge somebody's lending by their credit score. It's quite unfair, because a credit score at very best is historical. It will be, what payments did I fail on? How many pieces of lending have I got? What information can the big credit companies provide to me, which are fine and admirable businesses. But then again, what we did was with open banking, we addressed a legacy problem. The role and the potential to address financial inclusion is enormous. As somebody that comes from a background of social banking, from credit unions and people in underprivileged positions and building products for them, to be able to be assessed by your bank account activity accurately is very important. Why? Because you can get to the statements, you can get to the policies. It's very important. We can assess people on cash, not on behavior. A difference there. Now, we have great standards, we have great rules, but we also need another crucial point as well in this journey, and this is what open banking in the UK got right. And forgive me that they got it a lot more right than other countries. They built trust. And in that trust, what they built was, in the open banking entity that was formed, they built a directory. And if you want to be in the club, you've got to be in the directory. And the reason is really simple. It's called the trust framework. It's so that we can identify who is in our ecosystem. Should they be there? What can they do when they're there? And can I check they're going to be there on every single occasion? That is the most powerful part of open banking, coupled with standards. It means that what we do is we link people together and we make sure we credentialize them. Now, we've got open banking, we go to payments. I can talk about the HMRC I was heavily involved in.
Sorry,
I
we'll
think it's in excess. I think we can talk about HMRC, which is over £30 billion worth of payments now. No mistakes, no suspense accounts. But we've got to look at where it goes next. So we've got payments, we've got balances, we've brought them together with open banking. But what do we do now next? Well, we've got bank data. And it's very important that we don't just talk about what type of data, we just make a generic statement to say bank data. What can we do? Well, look at a few initiatives. We've got a great example of that trust and standards being extended, the trust framework and standards and the rules, to produce anti-fraud measures. In the UK, we have confirmation of payee. We ask a bank account for attributes, we try to confirm the name of it. What we do is we prevent fraud, because we stop people using the wrong name with the right account number. We are cutting down a bit of account takeover. In the UK, at the end of this year, they'll launch something called enhanced fraud data, where banks will exchange information. But the critical thing again is it's delivered under standards, and it's delivered under a framework where trust is established between the parties. So open banking gave us a great deal of addressing many legacy problems in banking, getting the bank statements to lenders, getting the bank statements to accountants, making a new payment method to people who didn't have a card, allowing people to be judged on their bank account behavior instead of aged credit data, and I believe they call it a thin credit file, and being excluded as well. But what it actually did was much more important. What it actually gave us was a framework and a set of rules that we can expand and look way beyond the horizons we are now. We can look at exchanging any data within a bank, augment it with third-party data, and transmit it safely within an ecosystem for people we trust. We can prevent fraud. We can potentially use it for partial identity. We can use it for confirming people's activity in account processes. Many of the legacy problems we faced in banking over the past 50 years, since the advent, I think, of the Bishopsgate system in the late 80s, which was the first internet banking or online banking, that one journey now matures into open banking. And really what we are there is we're now looking at getting very smart. I don't like the name open banking, for the record. I think the word open causes alarm. I do like the word smart. We now see a lot of very smart initiatives emerging across the world, and they're picking up, in many cases, the basis of a trust framework, standards and rules, very high performing technology in the UK. And I look forward to the next few years to see what happens. Thank you very much, everybody.
Thank you, Simon. That's a brilliant introduction to open banking and how it's been evolving, what's been working, what's not been working, and also in terms of the framework, the trust and standards framework is extremely important. Of course, using open banking as a blueprint as we move across to open finance. So we're going to now hear from Jakub Piotrowski, and Jakub is going to talk about what it means to process data and really process data. And it's sort of picking up on some of the points that Simon made in terms of understanding your customer more, basically, and gaining deeper insights. But I'm sure Jakub is going to expand on that further. So we're going to put him in the spotlight. Jakub, away you go.
Thank you very much. And hello, everyone. So my camera was off, but when Sam was talking, I was constantly smiling because I couldn't agree more. Standards are essential. And if we look across the continent, places where open banking was very successful are the places where there have been enforcement of standards when it comes to authentication, like the Swedish bank ID, although that's probably the best thing that happened to open banking in Sweden, with not so much standardization across the data access, or perhaps in Portugal, where SIBS is providing unified access to data. I'm going to speak to the point of what to do with the data once you have it. And actually, this has been, in my view, largely disappointing story when it comes to open banking, primarily because financial institutions, especially the large ones, are not very good when it comes to dealing with data. And luckily, what we are looking now is a push towards AI. Now I'm going to split AI into two topics. One is the currently cool question of how generative AI or chatbots can help you manage your finances. I'm going to take that out of the picture because it's basically not something we're ready to deal with, because we don't have regulations, we don't have a way of managing the financial models and so on. But there is quite a lot in terms of AI techniques that help process transactions, process data, process financial picture of the customer, and actually do something meaningful with this, which hasn't been really a domain of banks. So there are some isolated cases, as Simon said, when it comes, for example, to lending decisioning or risk or detecting fraud, when there is quite advanced take to how to look at AI, how to look at ability to find patterns, how to go across the customer data set when looking at single customer, but also look at your whole population and find things that are meaningful. But aside from those isolated cases, financial institutions haven't been very good at dealing with the data that they have, to the point that even if you look at your personal banking account, probably the offers that you are getting are pretty generic, and that's just a sign of the bank not really trying to understand your data, not being able to personalize how they talk about the offer, and that's important. That's the revenue, and we didn't even touch upon how they could help you manage your finances. Luckily, this is changing. Luckily, the evolution of AI, and again, generative AI, not very good for providing financial advice, not very good at math, but good at analyzing patterns, good at putting order into data, is probably, I mean, hopefully going to lead banks into changing how they are working with data, which means that we hopefully are going to see a renewed interest in using smart data, in using open banking with applications that go beyond those very specific, high impact, but still isolated cases. Now, someone mentioned credit scoring and credit bureaus, and this is a perfect example of how we have an ecosystem of organizations that are built on ability to access data, but it's all done in a way that it's not very transparent and based on mutual agreements with organizations and so on. But that data, every person should be able to grant a financial institution access to all this information. This goes way beyond the scope of open banking currently, because it's all your financial products. It's not only the transactional ones. It's not only the current account or the payments account. And that leads to lots and lots of scenarios which are beneficial for everyone involved. One of the cases which is currently fairly hot and is being discussed a lot in the United Kingdom is the topic of consumer duty. So what is the role of financial institution in leading to good outcomes? And my view is without smart data, without being able to get full understanding of the customer, it's not really possible to fulfill your obligations when it comes to consumer duty, because you don't have full understanding of that person. Now, that understanding isn't tricky yet, because it requires a very personalized approach. It requires good quality processing. Well, it requires help from AI. Now, I hope that what we are looking at with smart data and PSD3 coming hopefully soon on the continent, and with evolution of the technology and push towards AI, that we are going to see a wave of interest, but also genuinely beneficial applications beyond the current scenarios when it comes to ability to help people with their finances, help to understand the patterns, help to make better decisions. And that's before we're talking about some generative AI reasoning and very active push towards certain scenarios. I hope that's going to happen. The last thing I'm going to add is I think it should, because there are few things happening outside of Europe which I think we should all be very aware of. First of all, in the United States, we have 1033, so the US version of open banking coming live, but also we have the tech giants like Apple, who at the beginning of this year started quietly providing account information services in the UK, very closely looking at this space. And perhaps that might be the moment when the big companies with strong relation with the customer decide that it's the right point in time to move forward and start to be more present in the finance space, which, well, it comes with risks. I think for sure every retail bank, every financial institution on the continent should be thinking about that potentially still being an open question. What happens when you combine big tech, smart data, and are you going to have a competitive edge by just being better in terms of using technology, or is the current relations we have with the customers enough to protect your position? That's all I wanted to share, but I could talk about this for hours, so I'm looking forward to questions and interaction after that.
Thank you, Jakub. That was great. Yes, I think there are a number of different areas which certainly I would like to probe deeper. And just to comment actually on what you said about smart data, in terms of when we think about smart data in the UK, it's usually around smaller data sets. And then there's this question around granularity. And of course, in the EU, there is this kind of controversy around just how granular that data would get. And I think the other bit is around financial institutions and how receptive they are, or otherwise in terms of opening up their data. So you've mentioned the big tech companies, but as you say, we could spend a lot of time talking about this. But let's move on to Xitong, because he's going to speak very interestingly about developments in crypto and digital assets. And of course, part of the scope of the FIDAR is to include these new innovative types of financial product and service. So Xitong, over to you.
Hello, everyone. I'm very excited to share my insights into the world of cryptocurrency and digital assets. And I'm going to discuss the realms of possibility and how open finance could potentially drive mainstream adoption. So as we all know, cryptocurrency and digital assets have been a hot topic in recent years. They captivate the attention of investors, entrepreneurs, and technologists. What makes them so intriguing is not just the potential for financial gain, but also the disruptive potential to revolutionize traditional system of finance. Those digital currency like Bitcoin have paved the way for new forms of decentralized finance. They have enabled peer-to-peer transactions without the need for intermediaries like banks or financial institutions. This democratization of finance has opened up opportunities for individuals around the globe, providing access to financial services previously unavailable to many. One of the most exciting aspects of cryptocurrency is the ability to facilitate crowdfunding in a decentralized manner. Through initial coin offerings and token sales, entrepreneurs can raise funds for the projects directly from a global pool of investors, bypassing the traditional barriers to entry posed by venture capital firms and banks. This actually democratizes investment opportunities, allowing anyone with an internet connection to participate in funding innovative projects and startups. In recent years, we see a movement aimed at leveraging blockchain technology to create a more transparent, inclusive, and efficient financial ecosystem. This is the idea of open finance. There are several related initiatives, such as decentralized exchanges, decentralized lending platforms, and asset tokenization, as well as EU's recent financial data access regulation we call FIDAR. Open finance has the potential to drive mainstream adoption of cryptocurrency and digital assets. At its core, open finance enabled customers to give the permission for third parties to access the data, which is traditionally held by only large financial institutions. In other words, we can see open finance seeks to democratize the access to data and financial services, enabling individuals to control their own assets and participate in the global economy without the need for intermediaries. So cryptocurrencies and open finance together will provide many opportunities for digital innovation and the creation of new digital services. Let me talk about a few examples. So tech giants such as Microsoft and Amazon have started to accept cryptocurrency payments for the cloud storage and computing services. AT&T, a multinational telecom company, is actually the first major US mobile carrier to provide a cryptocurrency payment option to customers. In a recent interview, Uber CEO revealed that Uber is planning to integrate Bitcoin and other cryptocurrencies as payment options in the near future. In the meantime, China's central bank continues to take aggressive steps towards assimilating its digital currency, called digital yuan, within its domestic financial system. Even Kazakhstan has been moving towards the adoption of its own national digital currency. Interestingly, while China becomes a pioneer in the digital currency development, the US is yet to even pilot a digital dollar. There is also an example from France. So Pipto, a French startup, raised 15 million euros to develop its platform for instant payments using blockchain technologies. However, with great opportunities comes great risk. The unregulated nature of the cryptocurrency market has led to instances of bad actors committing scalable frauds, raising concerns among regulators and investors. As we explore the realms of possibility, it is crucial to strike a balance between innovation and investor protection, fostering an environment where innovation can thrive while ensuring the integrity and the security of our financial system. I must point out that collaboration between regulators, industry stakeholders, and technology innovators will be essential. regulatory clarity and customer protection measures are crucial to building trust and confidence in these emerging technologies. We must ensure that they can reach the full potential in driving financial inclusion and innovation. At the end, the realms of possibility for cryptocurrency and digital assets are vast and exciting, from enabling decentralized crowdfunding to driving mainstream adoption through initiatives like open finance. In the meantime, we must maintain vigilance in safeguarding the integrity and the security of our financial services. Thank you for everyone, and I would be happy to take questions during our panel discussion.
Xitong, you've raised some really interesting points there, not least because of the there's two camps, isn't there? There's those that are in terms of pro-innovation, and then there are those who are, very aware of potential risks in terms of frauds being committed coming down the track. So it's a question then of balancing between those two camps, and of course the technology itself poses some inherent challenges, I should say. But let's come back to the Q&A, because I'm sure some of the panelists as well will want to have some comments on what you've just said. And we're going to move now to Marie. And Marie's going to talk to us about the FIDAR and some of the I suppose controversial elements of the FIDAR in particular, as well as look across to Latin America.
Thanks, Sam. So my company, Raidiam, invented the trust framework that exists at the center of the UK and the Brazilian open finance ecosystems, which are, by any metric, the most successful open banking ecosystems that we have in the world today. So much of what Simon was talking about at the beginning is what I'm going to talk about in terms of lessons learned and why that's appropriate to FIDAR, which is essentially FIDAR is addressing some of the issues that have evolved out of PSD2 in order to create a better ecosystem in Europe going forwards. So going back to trust frameworks basically create the rules of the ecosystem. So it assigns roles to the participants, permissions as to what they can access, and a technical means of people being able to get that access and authenticate genuine requests and authorize the secure sharing of the data. We're talking about banking examples, finance examples here, but actually it applies to and is appropriate to any type of data sharing. So when we start looking at smart data, it's appropriate for and already built for any type of cross-sectorial data sharing. It also is appropriate for any type of attribute verification. So it doesn't have to be sharing packets of data in order to create more appropriate and better products and services. It could simply be verifying genuine requests for payment, so confirmation of payee, or it could be providing age verification for access to restricted purchases, for example. So what have we learned basically from deploying this, building this technology and deploying it in the UK, and then deploying it again in Brazil and beyond? The UK, basically at the beginning of open banking, the co-founders of Raidiam realized that the most difficult hurdle to overcome in terms of data sharing in a multi-party ecosystem is trust. So building the trust framework, which enables a single sign-on for all of the participants, the data providers and the data receivers, into a trust framework, a technical trust framework, in order to have access to many, basically removes the existing need, which still exists in Europe, for bilateral agreements between the participants, which is a massive source of economic wastage. It adds complexity, adds risks, and it becomes impossible to scale an ecosystem where every participant is required to contract to each other. So it quickly reaches a point where that becomes impossible. It's also a nightmare to ensure consistency across all of the different agreements. And one of the things that FIDAR is allowing for when it comes in is compensation. So it's even more important than ever that liability is consistently handled across the entire ecosystem. So In the UK, we have that. In Brazil, we have that as well. The UK, the trust framework was built for the UK and then handed off. We then went on to develop the trust framework as a SaaS solution, and were able to deploy it in Brazil in just 6 months, and then open insurance for the insurance regulator in just 6 weeks. So basically, the technology exists, and it's become very, very highly evolved. The second lesson that we learned is API access. Simon mentioned the directory, and that's a really key element of a trust framework. You have a directory of all of the participants so that they can find the APIs that they need. With the UK, the directory is a great way of seeing who the participants are in the ecosystem and making sure that you are dealing with somebody who is allowed to be there. But it's not going that extra step further, which the Brazilian directory does, which is allowing discoverability of the APIs through being able to search for the APIs that you want to consume. And that is a huge enabler. So if you can find the APIs you want very easily, and you're provided with the technical means to connect to them, and that includes the PKI stack that provides the transport and signing certificates, tokenized consent from the consumer, etc. If you can remove all the barriers to accessing the APIs, then you are enabling people to focus on innovation. So that discoverability aspect is a key element that has enabled Brazil to scale as quickly as it has. The third lesson is around conformance. So it isn't enough to establish common standards. You have to have a way of testing that everybody's APIs comply to them exactly. People can build APIs thinking that they're complying to the standard, but with small discrepancies, it won't work. So the data sharing won't work. And that's something I hear a lot, particularly from small and medium-sized banks and TPPs. There's difficulty in accessing the APIs because of a lack of conformance. And that's a problem that we have in the UK and Europe. But in Brazil, there's a robust conformance program that's checking all of the APIs all of the time in order to make sure that everybody adheres to the same standard. And that's a critical enabler of a healthy, productive scheme. Another lesson we've learned is about funding models. So I think most people who are aware of open banking know that the CMA9 in the UK have paid for all of the infrastructure costs to stand up open banking to this date. And one of the big questions we have in the UK is how is that going to be done more fairly and sustainably going forwards? In Brazil, the way that it's working there is that there is a fair usage charge, which is weighted by size of organization. So this covers the costs of the ecosystem and the ecosystem entity that runs it, and enables more investment to go back into building additional functionality and features. So that's an example of a funding model, but that's something that we will need to be working on in the UK and in Europe. Just to give you some idea of the size of the ecosystems that I've just mentioned, in the UK, by January 2024, 13% of digitally active consumers were using open banking, which is a huge growth on 2023. Of that percentage, we have 18% of small businesses. Comparing these figures to Europe, the adoption rate in Europe is 2%. PwC also provided an estimate of total API calls in Germany, Italy, France, and Spain, and that was 6.4 billion compared to 14 billion in the UK alone in 2023. So the UK is significantly further ahead than Europe, and that is because of the common standardized way that we implemented PSD2 and the trust framework that exists, which enables the ecosystem. But when you compare that to Brazil, Brazil has 42 million consents, 28 million of which are unique to an individual or a company. And the weekly number of API calls, so comparing this to 14 billion in a year in the UK, weekly in Brazil, it's 1.5 billion. So that's triple what it was last year. So again, I think that is a testament to the enabling power of a dynamic searchable directory and a conformance program make the APIs work. So we will, I think, be talking a bit more about FIDAR in the Q&A, but the key points for me about FIDAR are that it establishes these data sharing schemes. These are trust frameworks. So a scheme which a data provider and data receiver can be part of multiple schemes, that they don't have to pick one. But in this data sharing scheme, the rules, roles, processes, security standards, etc., are all established for data sharing, and a central register is going to be maintained by the EBA. It's not enough to have a trust framework conceptually providing that governance if you cannot technically implement it. And that's what the trust framework technology does. It also allows for compensation, which again means that you need to have a very traceable and secure way of understanding what has been shared by whom, and you need to be absolutely certain at all times that you've shared it appropriately with people, that they haven't lost their permissions or gained permissions and you've refused them, and then that has created a problem for them and their customers. Another aspect of the trust framework technology with a centralized directory is that bad actors can be removed, permissions can be revoked, and that's for the entire ecosystem. So there's a lot of control and protection for people. FIDAR also allows fees to be charged. We have an example, which I'm happy to share with people offline, of a way in which our trust framework technology is being used already in the world to apply micropayments for access to premium APIs. So again, a trust framework technology can also do that. Unlike PSD2 and PSR, there's a need to demonstrate customer consent. Again, within trust framework, you can tokenize the consent, and that's part of the transport and signing certificates that are, you knock on the proverbial API door, you provide your credentials, you show that you've got consent, they authenticate it, and then the authorized access to the API happens. By the way, there is no data that sits on a trust framework, and there's no data that passes through it. It's merely an enabling layer that provides the governance and the security and the means of access. The final point about FIDAR is there is an emphasis on common standards. And I think this is where Europe has a real potential advantage. If you have the technical means of enabling the ecosystem, you have common standards developed, and Europe has the common laws across the Union, then interoperability between different ecosystems, different sectors, different countries is quite, well, I say quite, I'm not technical, but I believe is very easy to do. And the trust framework technology that I've been talking about is already proven to be interoperable and also infinitely scalable. So the technology is there. I think what we really need to see now is the technical certainty for data sharing. And then Europe has a tremendous opportunity, not just in banking, it's also in EID and other data sharing needs. And I think it's going to be a very exciting year.
Thank you, Marie. That's fantastic depth insights there, particularly in terms of the technical specifications, the technical need. It's not just about standards, it's about the ability to be able to implement those standards on a technical basis, and also in terms of the commercialization that sits behind. Because at the end of the day, if you want third-party providers to come into the market, there needs to be an incentive for them to do that and innovate as well. And I was quite interested in what you were saying around the infrastructure that we have in the UK versus what doesn't exist, I suppose, in the EU and also Latin America. But let's come back to some of those things in the Q&A. I'm going to bring everyone back now, end spotlight and bring everyone back. So you're going to go to what's called dynamic gallery view. It might take a few seconds for that to happen. And I'm going to start actually, while the panelists were talking, I'm sure each of you may have had a question or something that was on your mind that you wanted to develop further. So I don't think this is, there we go. Right. Okay, so I'm going to turn to Jakub and Simon on the technical side, and I'm going to just leave Xitong for a moment because I think there are some questions there, particularly around the fraud aspects, which panelists might want to pick up on. Do you have any comments or thoughts that you wanted to throw into the mix, Simon and Jakub?
Jakub, up to you.
Yeah, so I mean, I think that ultimately what we have seen is like the technology is less important than the use cases that you have. So like even if we are facing a setup when getting data or getting consent is painful and is not very obvious, as long as there is a strong incentive to get through that happens. Of course, the downside is the more complex it is, cumbersome, less seamless, and so on, the higher the motivation needs to be. So, and then this is the trade-off that we have seen. Again, like to go back to the example of lending, there's a strong incentive for the customer to go through, granting the consent and potentially refreshing that when it expires, because there's very clear value exchange. I know exactly why I'm doing this. It's very clear for me. Like I want to get to something, and as we are lowering those barriers by having better tech in place, by having more trust in the system, but also by just having things that are more seamless, we are enabling scenarios where the value exchange is either not imminent or maybe it's not something which is instantly clear. Having said this, obviously, as like we all do this every day, even like clicking at accept cookies, the easier something becomes, the more risk might be introduced into the system. So there's of course a bit of a balance. But ultimately, I don't think it's a question of technology. It's a broader topic. If there is a good value exchange, basically. So in other words, I would be, just like to finish, I would be happy to type in all of my data on typewriter if there was an amazing financial offer. I'm not going to do that. That's not on the cards, but it's like, it's just a question of how motivated I am. And unfortunately, lots of applications are not necessarily as appealing. So like we have to figure out a way of making it easier. The answer is through technology, but ultimately it's a broader ecosystem that you're looking at.
I think I was going to add, just to put in some as well, we talk of the APIs have been around for years and years and years. They've been there forever. The true magic of this is ubiquity, standardization, and controlling who can access them. And if you look at the growth in the UK of the areas it's done it, I mean, there was exponential growth where there was a big legacy problem. And if we look around the world, let's not talk about a territory or anywhere specific, there are several territories, certainly one we spoke to extensively as well, that have launched a bunch of individual APIs where people were responsible for their own standards, and it was a self-governing regime, and immediately they lost control. If you want growth, you have to have standardization. If you want to control the growth and make it safe, you've got to have trust. And if you want to go forward and make it scalable, you've got to be able to implement the standards. And I think did the UK write that down on a piece of paper to start with? I don't know. I'm not clever enough for that. What I know is that was an outcome, and that's allowed us to get where we are. It was interesting. One of the points you said to me is, where is the UK now? Well, it's a privilege to go first. It's also a risk. Because there's a flag waving exercise. It's wonderful as well and stuff, but you've got to get your momentum going. I sincerely hope that we carry on with our position to be not at the front, but at somewhere near the front, to go and these things as well. Because if you control standards people here to make sure up to date market reference, and you control who's in it, you have a scalable, extensible ecosystem that can be used for so many different things. And I think that the aggregation of those three elements is the success in, not just the API element. I think it's crucial.
Yes, thank you. That's it's helpful to hear the participants' views, and I think there are a couple of questions in the chat as well, which I'm going to pick up on. So there's one from Fiona Carlin and also from Nicole Breyer, and I kind of kept Xitong out there on a limb, but I'd like to bring Xitong in now to perhaps answer the question from, is it Nicole? In terms of how central banks, sorry, Nicola, apologies. In terms of how central banks, do you want to ask the question yourself?
I didn't ask a question about central banks.
Oh, did you not?
No.
So I'm confused with
I don't know enough about crypto. And
Fiona.
to ask a
Sorry,
question.
Fiona. Apologies. Arlene. And I'd be interested to hear more about crypto and individual currencies, especially risk factors for central banks. Xitong, do you want to tackle that question?
Yeah. Sure, yeah. So there are still really a number of kind of potential risks. So first of all, I would like to mention, for example, the loss of control over monetary policy. So, you know, central bank traditionally control the monetary policy by adjusting the interest rates, managing money supply, and influencing the banking system. So, but as you can see, cryptocurrency operate independently of the central bank and governments. So that's actually will result in a loss of control over monetary policy. So this is one of the major risks that I can see. And related to this is, you can see this actually create lots of challenges to the regulatory oversight, because the central bank, again, those kind of cryptocurrencies operate independent of the central bank. So central bank not easy to actually oversight or monitor this kind of transaction actually made through the cryptocurrency. Another potential risk is, I can say, is the financial sustainability concern. So because the cryptocurrency could potentially very volatile. So the price actually change dramatically and not like the ordinary currency. So that's actually can cause a lot of concern about financial sustainability and also the economic, sustainability. Another is the cyber security risk, as we can also see that. So that's those are the potential risks that I can see. There are also other related risks that if I have more time, I can talk more about that.
Yes, we don't want to necessarily major on the fraud aspect, but it's probably worth mentioning that it does very much depend on the technology itself. So there are some blockchains out there which you know, you are able to reconstruct who it is that sends payments or is dealing in that currency, but there is also some technology that doesn't, and it's that bit, I expect, which we'll need to have more of a discussion about going forward in terms of how you mitigate then the risk of those types of blockchain spreading fraudulent payments or indeed money laundering activity. I'm just looking at the chat as well for any more questions. I mean, there was one here from Nicola about the API calls for Marie. Do you want to jump in there, Nicola?
Yeah, I just wanted to know, Marie. Hi, by the way. Just wanted to know, do you think that the advancement in UK payment online open banking payments contribute to the significantly larger number of API calls in the UK? Because we're literally not there yet in the EU, or most countries anyway. Is that what you think is going to significantly drive the API calls? And then to I think Jakub's topics. That's not going to help us really get more data, is it?
So on the payment side, yeah, we have payments enabled, and actually HMRC, well, not mandating, but making it a requirement for everybody to pay their tax bills by account-to-account payments undoubtedly drives API calls, and I think payments is overtaking data in the UK now. So absolutely, it's a contributing factor. Over to Jakub for the second part of that.
Yeah, but just like on this part, I mean, absolutely. I mean, payments is the most successful part of open banking in terms of generating value. Of course, there are some additional aspects, like we already talked about lending, which are also contributing, but those are not as widely adopted as possible. And actually, to the specific question on this, on monetization, like monetization is a dirty word. I like to think about this as a value exchange. But there needs to be clear objective for the customer, something that I'm going to get from this, which currently, again, it clearly exists when it comes to lending. I'm going to get the product that I want to if I provide my bank. It makes sense. It's a very clear place. Side note, high street banks don't do that because they like only their own data. I mean, I don't want to say ridiculous, but it's really, really strange when anything related to lending really has to be your salary goes here and most of your spending is here. Therefore, we consider this to be like good information, and we're only going to use open banking information because that just complicates the process. But this aside, I think that in order to be able to provide more scenarios when there is clear kind of value exchange, we start to look at AI. And the reason why I'm saying this is because you need to look at applications that are tailored to a specific customer, which means that you need to have something which is truly personalized and is truly based on that specific data set that you're getting. Now, of course, you can put an analyst to look at individual finances and provide something, whether it's a product offer, whether it's advice, or whether it's anything else, but that doesn't scale very well. So being able to do that at scale requires getting better at data processing, which then unlocks more sophisticated, more personalized, ultimately more valuable scenarios at the cost which basically makes it feasible. So I think that the path to having more options for monetization is just being able to do more with the data that you're getting. And again, like for multiple reasons, especially the larger organizations are not doing that. Again, there are reasons. So, but it's just also something that that you need to get better at before you can think of reasonably convincing customers to share more data.
See you.
Yeah, just a key thing. Data calls dwarf payment calls in the UK, Nicola. I'm on the open banking page at the moment, and you've got, for your payments, you've got like 6.2 million in July last year, where you've got 32.9 million actual API calls as well. The thing is about data is that, and for those of you that people in lending, and when people want to share the data, they don't want to admit to it. So it doesn't get quite the fanfare that the corporate gets, because the corporate gets an enormous benefit from data, from payments. There's a huge thing, right? When they set out the CMA order and they said it's going to create more competition, create new retail propositions, and create all these new fintechs to do it. I've got bad news for you. It didn't do that. What it did do is it gave the corporates probably the best access to bank data and to bank payment facilities you could have, and the list is limitless. Accountancy platforms, lenders, every mortgage you go for in the UK, 80% of them. I'm doing one on a buy-to-let now. They've asked for my ASP information. Somebody I work with got asked for it for rent yesterday. The exchange data actually is the gold. The payments benefits the corporates, the data exchange. I think it's got the retail benefit for it, but forgive me, the data's huge. It's just quiet.
Absolutely. And I think in terms of everything that we've been discussing today, in terms of opening up all of these data sets, we're only going to see sort of an explosion then in terms of the amount of data that's going to be, we'll have access to, but also in terms of the benefits that it can potentially have for end users. And I just wanted to come back, I suppose, two things that's on my mind is in terms of permissions dashboards and what that means for end users, and also in terms of the smart data schemes themselves. Now, of course, the UK government here is keen to focus, I think, on energy and transport in the first instance. And if you've got any views on that, I'd be really open to hearing those. Anybody want to jump in?
Yeah, so on smart data, there are lots of really cool pilots and proof of concepts that people are already working on. There is an open transport organization, for example, and if you, I mean, one of my favorite ones is not in that sector, but it's looking at digitizing the entire home buying process. So if you can assign identity to a multi-person transaction, which yes, you can. Then you can have the whole process of buying a house made much quicker, less risky, less costly. And that's an example of a multi-sector ecosystem. So all of these things, again, the hard thinking has been done about a lot of the questions in terms of what the ecosystem would look like, what the benefits are, what the value is, and the technology does already exist. So I think when we get the rules, the standards, and the deep thinking about what it should look like, how to actually implement it, is pretty much already there.
Great, thank you. And on permissions dashboards, Marie, do you have any thoughts, comments?
Yeah, that's a really interesting one. So I think that in a cross-sectorial data sharing ecosystem, we will probably have a role for data intermediaries that are representing the consumer. So a lot of the work, if people are interested in this, people like Inrupt are doing, for example, personal data pods. So going back to Jakub's point about, what's in it for me, happy to share everything about my data if there's enough reward for me, whether that's providing me with a better product or service, or providing me with financial compensation, for example. Somebody once told me that in the future your car will become a profit center for you, not a cost. So as it's driving along, it's surveying the state of the road, it's mapping, it's providing all sorts of data back to lots of different people. It's harvesting energy and selling the excess to the grid that it's driving through. So you can see how this future could actually be rewarding people for their data rather than the big tech companies that have made so much money off us in the past.
Yes, and that's certainly been one of the concerns, hasn't it, in terms of it's all about getting access to our data for their purposes as opposed to having access to data for the benefit of everybody else. So that's great, thank you. I'm conscious of time because we've slightly run over, but I would like to ask each of the panelists for one kind of key takeaway message. I'm going to flip back to Spotlight to bring each of the panelists back into the spotlight. And I'm going to start, shall I start in reverse order? So let's start with Marie. So Marie, do you have one kind of burning or key takeaway that you would like people to hold on to as they leave today?
Yeah, I think it's, at the risk of sort of banging the drum, you need a trust framework in order to have certainty of who is in the ecosystem and what they're allowed to share, and the technical means of making sure that that is done appropriately. So I think that technical capability can be used for so many different applications of data sharing, not just open banking, open finance, smart data, confirmation of payee, etc. But you do need to have that if you're going to create a healthy ecosystem that scales.
Thank you, that's great. And I'm going to ask the same question to, Xitong. Although I'm having some difficulty with the tech because I can't actually see how I can put you in the spotlight, Xitong.
Yeah, so the key takeaway is, I think, the cryptocurrency basically democratize the access of funds, as we can see, and the open finance democratize in terms of the customer can give the permission to a third party so that relevant stakeholders can access the data. So in order to create more kind of digital innovation, I think that's the key. But considering the benefit, but there are also always the risk side we have to keep in mind.
Great, thank you very much. That's super. And I'm going to now turn to Jakub.
Yeah, so I would say that the better we are at dealing with the technicalities like trust framework, like standards, like regulation, the more attention we need to pay to the data itself and to how we can get the most value out of it in a way that enables scenarios that are currently not feasible or do not offer enough value. So I think that we are still at the stage where we spend a lot of time on paving the road, but we are not necessarily fully using it, and that's ahead of us.
I really like that analogy, actually, in terms of paving the road. So let's pave the road to Simon to end with his key message.
Oh, I'm sorry. If you're gonna make this grow, we all work in it and understand it in granular detail, and we use acronyms and we use words, And what we've got to do is make it relative to the audience that can consume it. And I'm going to quote a guy called Paul Fairless from Sage, who said that, open banking is a marvelous revolution for Sage because it gives them sticky customers. They get their bank accounts in there really easy as well and stuff. And the statement they said was, don't use open banking. We'll just get your bank accounts in safer and faster. And if we're going to grow it, we're going to make sure that the consuming public, which isn't us, we're the creating parties of this as well. We've got to make sure that our language is accessible, approachable, and not scary. And I think if we do that, there is a revolution coming on. And I look forward to banking and smart data and energy all becoming things that we don't even think about. We just have access to them at our fingertips.
Brilliant. Thank you so much. That's great. So I'm going to turn off the spotlight, bring everyone back. And I just want to just take some moment. Just want to thank everyone again for coming today. And I'm sure you'll agree with me that we've had an extremely broad discussion, and that was purposeful because I think what we wanted to get across is that this is actually an extremely broad area. But then picking up on the points that all the panelists have made actually is that there are, I suppose, precedents for sharing data in a safe and trustworthy way. And it all comes down to standards and having the technical capability to implement those standards. So thank you all again. Yes, and we'll see you next time. Bye all.
Thank you.